When we look at disaggregation of ROA, we can go one level deeper. So ROA we looked at as R, net income, divided by A, assets. But what if we break apart even further and bring in the dimension of the income statement of sales? So the disaggregation breaks out ROA into profitability and asset turnover. And this is exactly the example we had in class, where we had both companies at 12% ROA, and one did it with very high turns and very low margin. That's like the Safeway example. And the other did it low turnover and very high margins. And that's the one we use like luxury goods, like bags or diamonds, things like that. So there are two ways to make an identical ROA, and the disaggregation helps us understand that, as it did in our class the other day. When we look at profitability and analysis even further, then we can break out this nice little flowchart. ROE can be disaggregated into ROA and financial leverage. That's the first one we did, the DuPont. Then we could further break out ROA into profitability and productivity. That's the net profit margin times the asset turnover. But when we look below in the green section here, we see that we can go even further. Say, okay, I know you're profitable, but let's look at where you're making your profits. And that's when we look at gross profit margins, look at operating expense ratios, and net profit margins. And productivity. Here's where we look at how well do you run your balance sheet. That's essentially what we're looking at. And are you lean and mean? And leverage is just a measure of debt. And we're assessing not the amount of debt, but also how safe are you? Are you able to pay off your debt? Are you able to earn enough to comfortably repay the bankers? And that's what we'll look at next, is these green boxes that represent some more refined analysis that are quite important to not just do the top level or even the second level. Now we're going down a little deeper into almost the account level. So analysis of profitability, and I just kind of carried forward the left side of that chart here so we can remember that. And we have three green areas or boxes. One is gross profit margin, which shows the relationship of the sales price of the good with what it costs you to make it. Or if you're a retailer, what it costs you to buy it from your supplier. And it's the highest level or hint as to how much money we make. And we like high margins, right? Because it means that you're adding a lot of value. So if a can of Coca-Cola costs you $1 and you're able to sell it for 10, that's pretty good. That also means you're probably at a theater or at a ball game because you can command high margins. But if you're in a normal retail competitive environment, you're not going to sell a Coca-Cola for $10 for one can. So this is what we mean by gross profit margin. How much money do you make from sales compared to your cost for that particular item? Next is operating expense margin, and it says, okay, let's look at all your expenses. How much does it cost to run the business? All the other things other than buying the can of Coke. And so we like operating expenses to be low. We like gross profit margins to be high. And finally, the net profit margin. They call it profit margin. I think that's imprecise. I think you should just put in net profit margin just to be explicit. A lot of people just call it profit margin. We're supposed to know that it means net income. But it's net income divided by sales. For every dollar of sales, how much net income do we make? Right? That's the overall profitability measure that we have. All right. The next area of green, which was in the middle of that chart, is productivity. And we're going to first look at the first four green boxes, which all measure how well do we run our normal business operations. And we call this the cash conversion cycle, and it includes three items. So the first they call accounts receivable turnover, but the proper measure when we're getting to kind of an analysis of CCC, or cash conversion cycle, is days sales in accounts receivable. That ratio is derived by accounts receivable divided by the daily sales, which is total sales divided by 365. The result of this calculation is very easy to interpret. Sounds confusing, but it's easy. It basically says how many days does it take you to collect your receivables. So that's pretty good, right? And we want to collect fast. We don't want to have a lot of people owing us money. We want them to owe us money and then pay us fast. So the fewer the days, the better. Normal commercial terms between businesses is usually 30 days. So in your mind, you should have the number 30. If it's 30 or less, you're collecting really fast. If it's more than 30 by a little bit, that's kind of normal. If it's a lot more than 30, that could be trouble. Next is inventory turnover, and the measure here is days in inventory. Similar calculation, we use inventory divided by cost of goods sold divided by 365. And that gives us a measure of how many days does it take you to sell your inventory. And this one, again, we want short. We don't want things sitting around. Favorite example there is bread, right? You don't want bread to sit around. It's true even for more durable goods. We like to make computers if you're a Dell computer, but you don't want them sitting around, so you want to sell them quickly. So days in inventory, we like to be low. There's no rule of thumb here. It depends a lot by industry and how your supply chain and your profit chain works. Next is accounts payable. And the turnover metric here is days payable, which equals accounts payable divided again by daily COGS. COGS divided by 365. The answer again is easy to interpret. It tells how many days does it take you to pay your bills. And we again know that normally it's 30 days. If you're paying 30 days or faster, you're a fast payer. If you're paying 30-ish, a little bit more, that's kind of normal. But as you go beyond 45, then you're stretching out your suppliers. And we hope the suppliers are okay with it, that you've negotiated those extended terms, because if not, you're now a slow payer, and that's not good for your credit rating. So we have three discrete measures of receivables management, inventory management, and payables management. You put them all together and you get cash conversion cycle, which equals the receivables plus the inventory days minus the accounts payable days. And so it shows how long does it take you to complete the cycle, right? The cycle means you buy inventory, you sell it, you collect the money, you pay your vendors, and you do it all over again. That's why it has the circular reference of cycle. And that's what we do: inventory, sales, and pay our bills. So let's look at a couple of examples. The first is Merck. Merck is a pharmaceutical company, and their cycle is somewhat normal. Their days sales outstanding is 60. That's slow, but they have a very complex set of customers, hospitals, distributors, etc. The days inventory is 125. That's a long time, right? That's 4 months, because 30 days into 120 is 4 months. So it takes them over 4 months to sell all their inventory. But it's okay in a way, I guess, because they have very high margin pharmaceuticals. And these are proprietary drugs typically. Next is days payable outstanding, and it's 63. Also kind of slow. I guess their vendors know that Merck's cycle is very convoluted and cumbersome, so they allow them to pay in 60. Merck is a very solid company, so I doubt that they are doing this without some cooperation and agreement from their vendors. And so there's a lot of work to be done, and you see this highlighted between 14 and 15, that it went down from 134 days, which is like a third of a year, to 123. Now, it doesn't sound like a big deal. Oh, that's 11 days, big deal, right? But the bottom part breaks apart where the impact in dollars. This section here is just lifted from the top. Then this section here is analysis to see, well, how much money is it worth? The change is a simple subtraction, and it went that the day sales got worse because they got slower, but the inventory got faster, they're selling faster, and they're paying a little bit slower, which again, I hope that their vendors approve. And we multiply times sales for AR and COGS for the payables and the inventory. And then this number is dollars. It's how many dollars we saved, or Merck saved, by making this change. Bottom line is they saved $400,000 in working capital. So they're able to trim their balance sheet. So a small number like 10 doesn't sound like a big deal, but when I say it's worth about $400 million, hopefully I got your attention. So that's Merck. Then here's a very unusual one. Apple has a negative cash conversion cycle. You say, how is that possible? The reason is their day sales is 26. That's pretty fast. People pay them quickly. And that's because their items are in high demand and their customers better pay them quickly or they'll cut them off. And it's a very desirable product, so I don't think their customers mess with Apple. Inventory is 5. Whoa, does it take 5 days to sell a computer or a watch? The answer is yes. That's because a lot of it's pre-ordered. It's sold before it's even made. So this enables them to have very, very, very fast inventory turnover. That's why they're so successful, right? And then finally, days payable. Their vendors give them 85 days, which is approaching 3 months. Again, very favorable for Apple. So when you do the math of days sales plus days inventory minus days payable, you end up with a negative 52. So this is highly, highly favorable that the vendors supply them so much cash that it covers all their receivables and all their inventory and then some. Not many companies have this scenario. So now we're at the bottom of the productivity stack, if you will, the green, and we're at PPE turnover, property, plant, and equipment turnover. Simply it means how well are you using your fixed assets to generate sales. So the calculation is sales divided by PP&E. And lower numbers means you don't make as much sales for every dollar of assets. Higher number means you make more money for every dollar of assets. So we want this number high. And how do we improve it? Well, we can trim our denominator by getting rid of unproductive assets, or we could not manufacture it in-house, which means we don't need a factory. We can do this through partnerships with other people. And we could also do sale and leaseback. Sale and leaseback means we have assets that are worth a lot of money. We sell it to a financing source and we lease it back. This is a way to shift kind of our economics. I'm not saying that sale leasebacks are always good, but if you're trying to trim your balance sheet and make it smaller, you may be willing to pay a little bit higher on your income statement in order to have more productivity on your balance sheet. So that's obviously something you would consider carefully. Property, plant, and equipment turnover is simply how much you can sell for every dollar of assets. You can fix it by selling more, or you could fix it by becoming leaner and meaner with fewer assets. So when we analyze the third side, which is the right side of that flow chart, is financial leverage. And here we look at two different methods. One is what is the amount of debt compared to your overall capital? So it shows the degree to which you finance through debt. And the other, which frankly I like a little bit better, is how well can you cover it? If you have high amount of debt, but you make so much money that it's no problem, well, I guess it's no problem. But even if you have small amounts of debt, but your profitability is so low that you can barely cover that debt, then that's not good, right? So you can see that the amount of debt is important, but even more important is how well do you cover the amount of debt, whatever that is, that you have. So let's look at the calculations. So first, the amount of debt is total liabilities divided by the shareholders' equity, which again means for every dollar of the denominator, shareholders' equity, how much debt do you have? If the number is 1, it means you're equal, right? 1 always means equal, numerator and denominator. So 1 means you have the same amount of liabilities as you have equity. So that's pretty moderate level of debt. As the number goes above 1, that means you have more liabilities than equity. As the number goes below 1, it means you're safer or less leverage because you have less liabilities than equity. So that's a pretty easy to interpret ratio, and that's liabilities to shareholders' equity. Next is this notion of coverage and looking at how much money you make compared to how much money you need to pay to satisfy your debt. And the specific calculation is earnings before interest and taxes, also known by EBIT, and usually it is found as operating income, divided by the interest expense. Think of it as I have $100 in interest I have to pay to the bank, and I make $100. Well, great, you made enough to pay the bank, but there's nothing left for anyone else. So a 1.0 means the EBIT equals interest expense, which means not good. You're just making enough to stay afloat by paying the bank. We want this number big, right? We want this number 5, 10, 20 times so that you know that if you miss by a little bit, you're not in jeopardy of not paying the bank. That's something we avoid at all costs, is to be in default on our agreements with our bank. So you can see that both of these measures look at leverage, but in two different ways. One looks at the amount, and the other looks at our ability to pay.